Palantir has just secured a major enterprise-level framework agreement with the U.S. Army, one of the most significant deals in defense tech this decade. This contract, valued at up to $10 billion over 10 years, marks a strategic shift in military procurement, accelerating the integration of AI platforms into core defense infrastructure. Yet, despite the sheer scale, Palantir's stock barely moved. What's going on? Welcome back to Arby's channel. If you're into business breakdowns, believe in humanity, and think introverts deserve a louder voice, go ahead and gently crush that like button and hit subscribe. And may your investments compound and your meetings be short. This agreement was announced on July 31st. It consolidates 75 previously fragmented contracts, including 15 prime and 60 subcontracts, into a unified procurement structure. The intent is clear: reduce procurement friction, cut intermediary costs, and speed up deployment of commercial solutions. For Palantir, being named in this single-source framework effectively positions it as the go-to AI and data analytics platform for the U.S. Army. As battlefield operations go digital, the military is leaning toward agile, repeatable, and commercially validated software solutions, areas where Palantir has long focused its R&D. This procurement modernization benefits not only Palantir, but also newer defense tech players like Defense One and Anduril. In a world where AI capabilities and real-time operational intelligence are becoming essential, the Department of Defense is under pressure to modernize fast. Budget constraints are real, yet the demand for scalable, modular, and highly available software platforms is growing. That's why the Pentagon is turning to commercial tech leaders with proven delivery and rapid adaptability. Palantir's partnerships with players like Anduril and Accenture Federal further solidify its foothold in defense systems integration. But one possible reason for the market's muted reaction is the contract's volume-based discount clause. Though analyst Louis DePalma from William Blair notes that these discounts haven't been quantified, suggesting they might be minimal or offset by future procurement scale. Another reason, there's no upfront purchase commitment in the contract, which might have disappointed investors hoping for immediate revenue uplift. That could explain why Palantir's stock simply followed the broader market downward after the announcement. Currently, Palantir generates around $400 million annually in recurring revenue from the Army across projects like Vantage, Titan, and Maven. As the NGC-2 program ramps up and Titan moves into production, analysts estimate that Palantir's Army-related recurring revenue could grow to $600 million within 2 years. Even without immediate additional spending, the framework creates institutional pathways for expanding deployments. These gains, spread across multiple programs under a single customer, support revenue stability and make Palantir's defense SaaS model more appealing to long-term investors. Wedbush analyst Daniel Ives sees this deal as a confirmation of Palantir's strategic position in the Department of Defense's software stack. It's one of the largest defense software contracts in U.S. history and is expected to drive broader AI adoption across government agencies. If Palantir can show that these AI deployments translate into tangible revenue and margin growth in the coming quarters, it would strengthen the company's leadership role in AI infrastructure investment. The real test will be execution. Can Palantir convert this massive framework into tracked, transparent contract milestones? Regular business updates will be key to maintaining investor confidence, especially as expectations for its commercial business are already high. Sustaining momentum in the government sector would also help anchor Palantir's valuation. The deeper value of this agreement lies in institutionalizing Palantir within the Army's data strategy, embedding it as a foundational platform for future defense software procurement. If upcoming earnings stay strong and new commercial wins materialize, today's market pullback might look like a healthy pause. The stock is trading near historical highs. Loop Capital just raised its target to $178. Citi analyst Tyler Radke expects Q2 revenue to beat estimates by 2 to 3%, possibly pushing the stock higher. Though he maintained a neutral rating, not yet confident enough to upgrade to a buy. This signals high market anticipation for Palantir's Q2 results, not only because of headline growth, but because the company is building a defensible, scalable commercial model at the intersection of AI and national security. Consensus expects $939 million in Q2 revenue, up 38% year-over-year. Both government and commercial segments are projected to grow 38%, reaching $513 million and $425 million respectively. On the surface, the growth appears balanced, but the drivers are quite different. Government growth is anchored by high-visibility deals like a $100 million 5-year contract with the U.S. Nuclear Agency and long-term Navy agreements in partnership with Anduril. These are policy-aligned, highly predictable revenue streams forming a protective moat for Palantir in the AI-powered defense trend. Yet it's the commercial business that holds the greater potential for valuation re-rating. Palantir is positioning its AI platform, AIP, as the internal AI control layer for enterprises, designed to integrate and govern large language models in high-sensitivity environments. Its collaboration with Microsoft Azure on defense-grade secure cloud infrastructure is a proof point of scalability and security. This unique operational layer allows Palantir to play a rare end-to-end role in the AI software supply chain, beyond just building models. Loop Capital's $178 price target is rooted in this non-model-centric strategy. Palantir isn't just training models, it's building the infrastructure to make them governable, deployable, and compliant. For highly regulated industries like defense, finance, and healthcare, this is a powerful value proposition. It's also why Palantir has been able to quickly convert pilots into production contracts, becoming a commercial driver for AI use cases. In Q1, Palantir posted a Rule of 83 score, well above the SaaS benchmark of Rule of 40, which combines revenue growth and operating margin. As the early-stage hype around generative AI fades and investors refocus on cash flow and unit economics, this kind of performance becomes rare and valuable. Still, some analysts are cautious. With the government base now elevated, future growth may face tougher comps. The commercial side hasn't yet shown true exponential acceleration. This means near-term earnings could become the key driver of stock movement, especially since the stock has already doubled year-to-date. Any underwhelming guidance might trigger profit-taking. Strategically, Palantir's long-term value lies not in a single quarter's outperformance, but in whether its AI software industrialization strategy is being widely adopted. That's why Loop Capital highlights the importance of ecosystem partners like Microsoft, Databricks, and Accenture. If these relationships turn into large-scale contracts, then Palantir's commercial engine truly begins. The company is now mid-transition, from elite government contractor to scalable AI platform provider. That shift is the leverage point for a new valuation narrative. The stock price already reflects considerable future growth. Until Palantir's enterprise scale becomes more quantifiable, quarterly earnings and forward guidance over the next 3 to 6 months will be critical to sustaining its valuation. If AIP's deployments show growing conversion rates into revenue, Palantir may emerge as the defining AI commercialization story. But if commercial scale-up stalls, today's lofty expectations could become a liability. Long-term investors should be watching closely. This is the inflection point.